Welcome. My name is Kai Whitney, and this is pretty much an opportunity, as I'm sure you all here have an interest in order flow trading or trading in general, obviously managing your risk. And one of the things that I have found over the years, actually it's been many, many years ago that I realized it's a lot, there's a lot of other people out there who have a lot more money than I do, have better information, better technology. And if I try winning at that game, I'm just going to lose. And so I learned many years ago that it's the best thing to do is just to follow the winners, follow the big boys. It's kind of the background I came from. So most importantly, it fits with who I am as a personality. You know, I do like taking advantage of opportunities, but I don't like overpaying for anything. You know, whenever something's on a deep discount, I always start to question. I guess you could somewhat say I'm kind of a contrarian, if you will. But this is an opportunity for you to ask me, anything you want about the NOFT order flow tool or order flows or competition and, trading and things of that nature. And I already have a couple questions coming through, and you can feel free to type in at any time. If you like, if there's a few of you who aren't familiar with who I am, I can go through, a couple slides here that I put together this morning. And then I can also show you, some examples, hopefully to address the majority of questions I get when I'm working with traders. It's a live working document of basically a game plan, a bias, a strategy, and what I'm doing is I'm writing everything down and I'm sharing this in the strategy sessions of the NOFT. And it's the same process that I went through where I wrote down every single thing I was thinking about looking at on when I would get in, where my risk would be and where my initial risk would be and where my targets would be, when would I move my targets. And believe it or not, lo and behold, after doing this for a few years, what it led to was I think I dumbed it down so much that I was like, wow, I wonder if some of this stuff could be automated or programmed. And that's how this all started. So, I'm just like you guys, except I do have a little different background. So let me just start real quick, just to be fair for some of you that aren't familiar with who I am. Let me just start with a couple things. First, I want to talk about my bias. So where am I coming from? Obviously this is a strategy that I came up with, and this is based on my real world experience, okay? And the majority question I get is, why should you even worry about what the institutions are doing? I mean, how are you supposed to track what they're doing? And how are you supposed to do anything about it? And so that's obviously it's a relevant question, but I tell you, with technology these days, it is getting easier and easier, and the playing field is being more level. So there is opportunity, there is more transparency in the markets than there ever has been. Before there wasn't even reportable volume, and then it became reportable, at the end of the day, then at the end of the, every hour and half hour and things of that nature. So obviously things have evolved, and if you want to be a trader full time, you also have to evolve. But the one thing that you can't get away from, no matter what you do, no matter even what the institutions do, you can't get away from the fundamentals of the markets, which is called auctioning. It's a dual auction market process. And one of the problems that I have found with the majority of information that's available out there, or strategies or software and things of that nature, is that there's no real, it's taking something and it's just like a one-off situation. It's if such and such lines up perfectly and it gives you a signal, you take the action. But what it doesn't address is context of, what happens if things go wrong, or can I anticipate what's happening before I take the trade so that I can kind of build up a criteria of which to believe that this trade would work and have an opportunity to become objective enough with real-time information, not stuff that's been, basically has been, historical or or lagging and things of that nature. So one of the things I like to do is I like to look at the markets as it's a big iceberg, okay? And I notated a couple things. Let me know if you can see this. This is the tip of the iceberg here. And the tip of the iceberg is pretty much what we are seeing on our charts. I should say what the majority of traders out there, specifically on the retail side, are seeing on their charts. And that's where they're looking at price action, and they're looking at moving averages and Fibonacci's and pivots and things of that nature, okay? So the whole price action thing. Also, I should put in here candlestick charts. A lot of people don't understand that candlestick charts, in fact, are an indicator as well. So we want to make sure that we understand, first off, we understand that there's a lag to that information. If you're waiting for the bar to close before you take a trade, then that means you're willing to assume more risk, okay? What I want to do for you today is help you understand more about the entire, not just a program. Let's say this chart here represents an algorithm or a program that you purchased or are interested in buying, right? I want you to take this entire chart and then put it into the entire context of the market. And I want you to think of the market as an iceberg. In other words, what you're seeing is just the tip of the iceberg, price action. But what's happening beneath the surface is what's more important. And that's where institutional money flow is occurring. And whether accumulation or distribution of very large positions, okay? And the fact is that we also have to understand that the market as a whole is basically a distribution system. And it's an opportunity for institutions and governments around the world to transfer risk. But you have to understand, more importantly, what really the market is doing. And the market, some people, don't take this wrong, but honestly, the market is not there and never was really available to traders like you and I. It's not set up for the institutions. It's all about information. And the closer you are to the information, the more power you have. So you really have to either have that information, be in that environment, or piggyback on those that have more money and have more information. So let me talk about the 3 keys to decoding order flow, which is, it's all about hidden trade locations, and it's finding beneath the surface of the market and trading, obviously, price action, but with a foundation, and that foundation is beneath the surface. Basically identifying where institutions are initiating and responding to levels. The second is having what's called an institutional bias, and that is where you become, the only difference between I thought about this a long time. The only difference that I found that I had while I was a trader versus doing this on my own is we had, obviously it wasn't our money, it was other people's money. And it wasn't as far as, oh, I was wrong on this trade, I'll just add more, this and that. We couldn't do that because it was our job. It was our job to do right for the client, for the bank. And if we messed up too many times, we'd get fired. So our job was on the line. So there was, obviously there was a lot more on the line than just taking a trade. It also helped that we had information flow that was not readily available until just a few years ago. Knowing what institutions were doing and at what price, what level. And then the power of order flow, and specifically the power of the markets trading between a dual auction market, trading between two, basically a range or a balance and an imbalance, or price is searching for prices. And the fact that in order to get the market to move outside of a range or fair market, there has to be obviously someone who is willing to pay up or sell at a worse price. And they have to be more aggressive than the other party, okay? And so when you can put a combination of these together, it can tell you a picture of the story of who's really maybe accumulating or distributing and then you can work off of that information, work backwards, and have a more objective reason to take a trade. Okay? Okay, yeah. So this is, again, this is from my experience, all right? I've been involved in the market since '94. Started as an analyst at a buy-side firm with venture capital and private equity. I then went to firms, the big bulge bracket investment banks, Bear Stearns and Swiss Bank, and I had the opportunity to trade for very large accounts. In fact, I traded for one of the largest accounts in the world at the time, which was $35 billion. And it would take me weeks upon weeks to accumulate or distribute shares, and there was enough at any given time where I could crush the market. But if I was, if I was selling something, I wouldn't want to hurt the market too much or show my hands, because I would show the street. I would show the street what I was really holding. It's like poker. And I would also, be working against myself and against my client, and I was at risk of either losing the account or not getting more volume. And that's how I got paid, was by doing volume. So, it's a little different than retail trading because it's not my money, but my job was on the line. So this is kind of, how I've come across this whole bias that I have. And again, looking at the hidden trade locations and why trade location is everything. And I teach in 2 strategy sessions every week, 90 minutes each, live, by the way, and usually small groups. And what we're doing is we will locate trade locations beneath the surface of the market, if you will, okay? And these are where previous institutions bought and sold. And then when price moved down to that level or up to a level, then we would look at price action in relation to the trade location, and that would be considered homework levels. And I post my homework levels every single evening so that everybody can take a look at where I'm going to take my high probability trades every day. So it's completely transparent. Next, why size matters. Again, we're back to that same question about institutions. Now, one of the most important things you want to understand is you need to know what the institutions are doing and where they're doing it at, because you don't want to play in that sandbox. You don't want to jump in the ring with those 2 elephants fighting. You want to step aside and you want to observe where, and you only want to place your bet when you know there's a high probability that one of those elephants is going to win or not, and what direction it's going to go in. And I've developed ways to measure this type of information, whether it is through imbalances or percentages of aggressiveness, how aggressive the other party is being, if they're absorbing the other side of the equation, or they are looking to set a trap to provide liquidity like a market maker. And it's really important to distinguish between size. And it's not about, the biggest fault that I see is, because everyone's trained, is if I show you a large buy order of 500 contracts, and on average there is 100 contracts traded, everyone here would probably say, well, I guess we should buy, right? But they're forgetting, first off, where did this 500 contracts take place? And also forgetting that in order for that 500 contracts to take place, it was most likely a limit order, and it was market orders that ate up that limit order, and so there had to be another side to that trade. So therefore, that's just one piece of information. That's not enough to take a trade off of. But the fact that it's 100 into 500, that's 5 to 1, right? So they're 5 to 1 more aggressive. So now if you take this information and you put it into the trade location, then you take the price action in relation to this 500. Then you can have a trade. And again, why price is not the main factor, I'll show you a couple examples. My favorite bread and butter trade is called the retail flush. And my motto is, it's the 95% of retail traders who fail, the high failure record, that is my holy grail. So I will literally wait until I see in numbers, not in an indicator, by the way, in the numbers, that a lot of people are jumping on late or too early. And then there's an opportunity for me to capitalize on that, and they get trapped, and that gives me opportunity. Okay, so again, price action and institutional money flow. I talked about the institutional bias, but let me reiterate that as a trader, losses are more important than profits. Now, what does that mean is that you really want to control your losses, and that's really the only thing you can control. You can't control what the market's going to do after you put on a trade. You can only objectively sit back and analyze it. That's all, the reaction. You can read. You can also take a look at other markets to help you stay in a trade. But the main problem with most strategies and indicators out there is they're just taking a look at an incomplete picture. You have to learn how to take into effect the entire market and the reaction that the market is having, and understanding that losses, as long as you mitigate those losses and you take the setup in the right trade location, there becomes a higher probability that you'll be able to make up those losses and even win. Another thing is that the retail traders take on way too much risk, and I've figured this out over the years now, and that's why the NOFT, once this has been established, from a game plan into a strategy, into private mentoring, and then, hey, let's see if others can pick this up, and let's create a program, and then selling this to large institutional traders who are willing to back those who learn this strategy. After I proved, not only in front of them, the strategies themselves, but I also proved with private mentoring customers I had that it could be taught or the information could be transferred. And I understand that most people don't have the capital that I had when I got into retail trading. It dumbfounds me, but it's from my experience now that most people don't even have $15,000 in a trading account. And I would say the bare minimum you need is $25,000 to $50,000. And if you want to actually make a living off of it, that's got to be in six figures or more. So the fact that you can leverage up and trade more than you have in your account, you're taking on way too much risk, and then therefore there's a huge risk to failure. So that's why the access to capital is really, really important. And having that institutional bias where you're trading other people's money may be the right fit for you. And lastly, it's all about probabilities to risk. It's not about risk to reward. It's all about that trade location, the probabilities of success, and then just going with the flow. Okay. Let me pause here, and I'm going to a couple examples. I want to start with something that I did last week. Started last week with the traders and that I shared. And again, this whole process that I went to, I want to go through a couple of the questions on the flush trades, but I want to talk about, again, why we follow the professional big money traders versus mom and pop day traders. And one of the largest hedge fund managers, Ray Dalio of Bridgewater, says you can win, but you can't do it by trying to beat the pros at their own game. So big money, it's relative terms, it's dependent on the market, instrument being traded. Big money includes governments, commercial traders, institutions, banks, merchants, hedge funds. Due to their relative trade imbalance, their positions and actions are easily recognized and tracked when using proper order flow tools such as the NOFT. Professionals create large imbalances in the tape and when they enter and exit. And it's based upon the context on where they're doing it at and learning how to read that story. Very few traders learn the simple logic of how and why price moves, and that's a very important component of the Noth program. You want to learn how to become an insider. You need to know the rules of the game before you play the game. So I went through, the game plan is scalp to trend based upon auction market theory, dual auction market. But I want to show you, for those that aren't familiar with order flow, let's go through a couple examples. And I have in these examples the long bond and the S&P. The S&P is from today. Okay, so I'm taking a look at, this is an example of sellers in control. So before I go into the charts, we're going to take a look at a wick here and a candlestick, right? This is the high volume node of the bar. Doesn't matter what bar this is. This can be any time frame you're looking at. These are sellers, 0 into 16, 0 into 18, 4 into 13. These are sellers hitting the bid aggressively. At a minimum, I believe, I usually use 3 to 1 or 3.5 to 1. So they are a limit order. They're limit order to sell on the offer. They jump over and they hit the bid. So they take the worst price, but they get filled. And then what happens is the inside inside bid starts to tick away, and you can see that in real time. When you start to see, and this is where most institutions can initiate bigger moves, it's not up here and not down here, but in the bulk, okay? And this will most likely be on a composite or within a range where they can hide a little bit of their information. Now, as it starts to release and come out of above, out running away from value, and you start to see sellers get involved again, there's a heads up that these are possible retail traders jumping on late. We like to get involved up here, confirm through here, and start risk starts coming in down here. That is basically sellers in control, initiative selling. Responsive buying is when obviously a seller's dominating. In this example here, what happens towards the end is something gets too cheap to keep selling. So they aggressively sold up here. They're not as aggressive up here. You can tell between the bold and the not bold. And then what happens is you're taking into effect the trade location, and then you're taking into effect price action. And if price action starts to trade around and start eating up some of these sellers, then you have responsive buying, and the value is left beneath or away. The next setup is where you have a situation. I actually have a trade here that I can show you where there's a number of sellers that got involved here, and this is called a ghost block. And this will draw out into the future a red zone or whatever zone color you use. And what happens is this can equate future, if the market were to come back up and address these sellers and reject, you have an opportunity for a sale. If it were to trade through, if you were to trade through these sellers, then you can use that as support and take a long. That's Murray. That's beautiful. I love it. Murray goes, I'm very new to trading, and this is this an advantage? Because this all seems to make so much sense. That is the key. To be frank, some of the best traders out there are not going to know anything, are not going to have any bad habits. I had bad habits coming when I started retail trading, because I was trading other people's money and large amounts of capital from a different mindset. And I had so much water under the bridge. And so I started reaching for every indicator and learning about candlesticks and everything else out there, and learning about different footprint programmers. And it wasn't until I started to really work with and own my strategy. And so no matter where you are in your trading, the most important component to trading is the risk management and looking through the auctioning process and just having the right information. No, Jason, not at this time. This is a work in progress. I'm working on something with the guys in the strategy session, but this may become into, there's a couple things I'm working on. I may build another helper out of this process, but it is available. You can see there's a few guys on right now, reading it right now. I make it available in the ATG session. This is just an example, okay? So we want to focus on aggressive orders, and those are the limit orders that are close to the market. The passive orders are the ones away from the market. Limit orders are going to show you liquidity. So if you have, say, 100 contracts or 500 contracts, 10 levels away from the current market, and that sits there and holds, that's telling you there's a limit order of someone willing to do something. It's an indication of interest. And the market is going to trade up to that level, because that's what the market does, is search out liquidity and value. So limit orders will show possible liquidity orders, and they'll add liquidity to the market. And traders actually receive credit for providing liquidity, but they're at risk of not being filled. What happens is the market, if they are going to miss this opportunity, they need to jump over to the other side and become aggressive, and at least get the trade done. So market orders will always take away liquidity and move towards limit orders. Traders are debited by taking liquidity but can guaranteed a fill price. An imbalance. This is when limit orders cross over and remove liquidity in order to get filled. We also want to understand in this process that volume leads price, that volume over time equals value, that market seeks value, that value is liquidity to place trades within, and market seeks liquidity to facilitate trades. Now, I went through examples. Here's an example on a sale. This is what, again, this little gray box here, that's the inside bid. So if you have a dome, if you had the dome and the print, and you have the ask and the bids, this here, this downtick, is telling you that the bids to buy are being pulled. So they're seeing information saying, okay, I better step aside because I think I can get a better price. So they start falling away. So this inside bid is what's dropping. And this inside bid is liquidity. And the market should chase liquidity, right? Limit orders, market orders. And so this can give you a heads up. And if it prints, holds, you have a short to confirm. And I'll walk through this trade as it's trading. I'm typing this stuff down. Here's one where I actually show, I get a snapshot of the trade. And this is an example where I actually took two losses. This was a loss here and a loss here. And my out was a break of the buyers. And I got out as soon as it retraced up. And so I took I only got one lot on, one contract traded below, printed, the buy imbalance lifted and failed quickly, closed out 3 ticks. The second one, same thing. As soon as it lifted, came back in and hit a aggressive sell, I got out. So I lost 4 ticks total on that. Now, the third contract started with a consolidation at 11:02. So I initiated, I thought I had 2 contracts on this. Oh, I did. This is, I took the snapshot after I let go of one. Okay, I got 2 contracts long on this. And just by hiding behind these buyers, following the market up, this one lot peaked at 1,000 as of 12:30 and continued as I just followed and followed. You can see I'm hiding behind. So this is objectively addressing the targets. this blue line is a homework level target. And so I'm hiding because I'm getting closer and hiding behind because we're getting closer to a target. And that peaked out at 1187 on one lot at 1240. And then this is what happened after. And I go through the example. I know I'm taking too long. I'm trying to finish this up real quick, you guys. Here's the win-loss. So my first two trades, again, keeping your loss small. The first contract I took off covered those losses and then some. The last contract printed 1,000, and then I had another trade after that. And I go through and I talk about what I'm doing, how I'm lifting my order, example after example. And then I did a couple today, and then I actually had a chance to take a video. So let's take a look. Here's today's trade, and I promise I'll wrap up. This is the S&P. This is a 4181 tick chart. Let me see if I can. No, I can't get any larger than that. 4181 tick chart. Okay, so it started. This is our true value indicator. This is telling me where value was based upon the opening. So long ES as it was coming into true value area measured from the open. I looked for a trade below. I looked for it. Here's my bread and butter trade. I get the trade below outside of value. I get a buyer stepping in here, a buyer here, and a buyer here, almost like a triangle. And I get the opportunity to get in, and my target is the value area high of the open. And it was confirmed with buy-in balances off the bottom and then followed up the uptrend. The main target was a true value, which is also homework level. The next two trades I took were small shorts. So let me ask you, after this move, or should I ask, how many people have a problem trading or knowing when to fade a trend? A move that has gone too far and all you're trying to do is short it, short the tops, and just getting run over. How many people has that happened to? So what I did here, let me see if I can get this a full. I took a trade here. Let me pause it. Let me set it up for you. So this is the homework level here that I was showing you. This is coming into, let me see if I can pause it. Okay, this is starting to show me buyers are getting less aggressive, okay? And they start to come in. Then the buyers step up again, and they trade through the value area. They came up, and they failed. And so my opportunity is to get short. Now, I identify my risk. I type this in here. This is not automatic. But my risk is this cluster of buyers that you can see here clearly. And my target are these block trades. And this orange line is a developing COT. So it's following the point of controls on each bar. So again, giving me objective targets. Now, this is not a home run trade, okay? This is a very, very uptrend market. But I just want to show you that when you have the proper information in the if-then scenario, and you have data that's coming in that is instantaneous, you can take trades and set your probabilities, which are to initially, I'm hiding behind these buyers, this block of buyers. And so as the inside bid here starts to drop in, I'm looking for a print, an aggressive print. I'm not getting it. So I start to find my, and I actually made a mistake. So this was a live mistake, by the way. I meant to buy back at 80.50, and I ended up putting up three sales. But what's important to understand is I'm anticipating, because I'm starting to see responsive sellers, starting to see buyers become less aggressive. We come up into a homework level right here. I trade the reaction. Now this is a bad trade. I got in at 82. That's not a bad trade. This was too fast, and I'm trying to clear all these buyers to be safe. Absolutely. Understanding market structure and being able to see clearly with, whether it's the NOFT or anything else that you're using, you guys. Remember, I'm not here to poo-poo anybody. I just have a strategy and opportunity and investors. And if you can learn this, worst case scenario, you're going to do well for yourself. No matter, like I said, I can do this with time and sales in level 2 in a dome. That's all you need. What the benefit of NOFT does is it color codes stuff. It tells you where sellers are or buyers are. It tells you where they initiated their trade. It tells you your risk ahead of time. So that risk level here, these buyers identified where the market's going to pause. We start to see buyers start to come in here. Not enough sellers. So anyway, again, this was a mistake. This is supposed to be a buyback. As soon as I get in, I'm like, oh my God, I'm 8 short. And so I close it out. And then okay. So the numbers below here, this is a delta. So the bids and the offers, the aggressives, and the difference between the two. And this is a rolling average. You can change however you like. The numbers below each candle, there are these numbers, this number here is telling you that sellers in this case are drying up and or buyers are starting to absorb the sellers. So they're responsibly buying. And this will show where buyers started to initiate their trade. Then the block trades occurred. This orange line here, these 2 orange lines, those are block trades. So those are large. So they accumulated, they absorbed, and then they threw out 2 block buys. And so these block buys are now my target. So if I'm short, and here's where I made the mistake of getting in 8, and I closed out to 3 short, and I'm completely thrown off. So, I'm looking to get out. I messed up. But my target was down here if I didn't make that mistake for my remaining 2 contracts. And that would be where the buyers responded and initiated. And this will go out into the future as far as you like. Okay? I have another one. Let's see. Again, these are just examples of where you can short into, if you have the right information, you can short in an uptrend and not get killed. So that's one of the big things. No, this is not the same trade, is it? Yeah, that's the same trade. Hold on. Okay, here's another one. All right. So this one, let me pause it. Let me wait. Okay, let me pause it. Let me talk about it. Okay, so you see these 3 numbers. It says 21, 14, 1043, and 199. Okay, so that's telling me that as price is going up and up, there's less and less buyers willing to buy up. So it's kind of like a heads up. It's a warning, okay? This red line here is a standard deviation of the VWAP. So that's telling me when we got up to 91, 90, I should start looking for opportunities to get short. Now, I can also see a block trade here, a block trade here. The slope of the COT is strong. And this is a 4181 tick chart, by the way. So that someone was asking about a tick chart. This is a tick chart. COT is basically a high volume node. It's where, this is that orange here. This is where the majority, more traders commitment of traders. Point of control, it's really commitment of traders. It's where the traders committed their price. There are more trades at that price. So it's called the commitment of traders. And this is based upon option market information. Point of control is going to be in the composite, and that's going to be a high volume node. That's going to be your point of control. There's going to be a TPO, time price opportunity point of control, and there's going to be a volume point of control. That's in the that's the difference between the auctioning and the market profiling. Yes, and low volume nodes. Those are where I find my homework levels. So this blue line here was that same homework level that from that previous trade. It went up, it shorted, and then notice how they bought and they bought and they lifted, and that same short I took, traded around, came back in and became a long opportunity. So again, so I'm seeing they committed themselves all the way up here at 90.50, and I'm also seeing that buyers are down here at 88.5, and this is drawing out that gray line into the future. So that is risk for me if I'm going to get short. Okay? And as we're trading up, I'm saying, okay, maybe these guys could be taking that breakout trade because I'm seeing less volume. No. The same, so question is, do you use the same tick bars for crude? I will use 987 tick charts for crude. 4181 tick is what I'm using for the S&P. And I use 2500 volume for the ZB and the 10-year. Okay, so I am waiting because I know my risk is right here, but I also have opportunity. I am going to try and trade. I forget where I put the trade on. You'll see where I put it on. But I put the trade on maybe beneath here. But again, my objectives are all already set up in detail. And now I'm watching this inside bid, inside offer. I'm watching for this gray thing to drop first. And if I see it drop, then I have a short. Okay, let me pause there. Did you see that there was a buyer right here, and then it went neutral? That means, and then it printed a seller right here. So what it means is that buyer just got absorbed by the seller, and that happened in real time. Now I want to see this print hold, and then the inside bid drop. Okay, so this gray area is outlining for me where there are buyers. So these buyers lifted this market even further. But yet I'm having two indications that as these buyers went up, even though they're aggressive, they're still getting less and less every single price that it goes up. So they're becoming less aggressive. So if price action falls away from that, I have an opportunity to short. No, they're not new. Same. You can color code these any way you like. The one thing I've done is you can do this with Renko bars, range bars, volume bars, tick charts, minute charts, you can do daily charts, weekly charts, you name it. It doesn't matter. It's how you are going to trade. So now I'm typing out and showing you where my target, my risk is this level here with that orange line that's drawn out. That's my risk. So did I have 5 contracts on here or 3? I forget. But anyway, do you see where my risk, I drew that risk? You see where if I'm short and I start to see this buyer come in, see that buyer's 307? Can everybody see that? Okay, so it's telling me now if I'm short, my risk is buyers coming in, right? So it's telling me buyers are starting to become aggressive, at least 3-1. But I also see an auction here because there are also equally aggressive sellers. So it's kind of like, all right, here's a little play box, sand trap, and now a couple elephants are battling. I obviously want to stay with the winner. And if the buyer takes over, he's going to absorb this seller and start to lift and take me out. Or the seller is going to absorb the buyer and the inside bid is going to drop and continue to drop. Okay? assuming there are buyers and sellers alternating from one bar to the other, how long do you wait until you get clearance on the side? Okay, so this is what I need, and in this anatomy of an auction, I break it down in written form where I'm talking about if I'm getting around a level, okay, let's just say this is a level, 88 quarters a level, okay? If price comes down, that's just one thing. That's only one thing. That's price action, right? This is what's happening beneath the surface, but I can see that if price can continue to trade around these buyers and then the inside bid drops and starts to fall away, then I can short. If price comes down and all of a sudden it flashes right back up, the market flashes, if it will flash on me, that's telling me something. That's telling you that there's an auction happening and that I'm at risk. So I just the inside bid starts flashing and the inside offer doesn't follow, then I won't take the trade. It's the beginning of an auction. When two players are brought together at a price and price trades there for a moment, that is an auction. If price then runs away somehow, whatever happens, bids drop away and the bids give up and the market falls away. But yet up here where that auction was taking place, not all orders or all participants were paired off, then this can become an unfinished auction and become a target for later. All I want to tell you guys is I used all the order flow tools out there, and there's some great tools. And if you know how to trade, you can use just a dome. If you need hand holding and you need the opportunity to live 90 minutes a day, look at markets, analyze, study, strategize before, on Mondays and Fridays we strategize what to happen for the market. For instance, yesterday on my strategy session at 1 p.m. I told the guys, listen, this week is going to be an up week. On average, these holiday weeks are up, 1.5%. If you don't want to, I would say, I told them, you should take the opportunity to go back through videos, modules, replay, and just buy some options. Buy options, go long for the week. And that's kind of the game plan for the week, is long bias. So we can see that here in this trade, as it's coming down, a couple things happened. It looks like I sold out of whatever I had, and now I'm starting to hide. So you see this 961 and see my last contract? I'm going to hide behind that seller. And the idea is if the buyers come in and take out this 961, well, that's a lot larger than my last contract. So you're going to see here how I follow the market down, identifying my target down here, because this gray line beneath was made previously when a bunch of buyers like this showed up. And this gray line here is going to go out into the future, just like this gray line here went out into the future. So this is telling me objectively, hey, this is a target, or for instance, this is also risk, so that's also going to be a target if I'm short. So now I'm following. I took my risk off here because this is where the value of the COT is, so I take that. Then it trades around again, and I see a bunch of sellers jump on. See all these sellers? So the sellers, and now this gray line is going to go out into the future as well, and this block trade came out. So that's telling me I can hide behind this aggressive seller. And I think I might keep going a little bit further. But if you've ever been afraid to short in an uptrend at the top of the market, this is the information that can hopefully give you confidence. When you understand trade location, the context of the market, have an institutional bias, and you have your risk identified, your targets identified, and you understand the strategy, I'm just hiding behind these sellers. So I hide behind this seller on the last. I'm going to probably hide behind that 927. See this buyer starting to come in here, right here? You see how he went away and dropped? See the bid dropped away? So I think I'm about to bring my risk in. Okay, so I come in line with that seller in the same hopes. Okay, see, let me pause. Do you see how there was a seller in red numbers, bold, and then it's gone? So that's telling me that there's a buyer in here absorbing the seller. So I'm at risk now, right? All he has to do is put a couple trades together and, take me out. I'm also at that homework level right here, which is now support. So let's see what happens and continue. I do get taken out. Okay, the seller came back, so I get a couple more. Maybe I come down. So he came back and he held. And there's the inside bid. I'm looking for this thing to drop further, but I'm pretty much near my target. There it is. Inside bid dropped. So I think, I see a buyer come up again. So I hide. And so I want you guys to understand that this was in a huge uptrend. Most people get run over. I had a great long, but now I have a couple of income trades. But notice the risk that I took on. I don't recall. We can look back, but it might have went against me a few ticks, but not enough information to get me out. Let's see what I started this one with. Let's see how much it went against me. Okay, so I went. Okay, so I saw zero. I know I took minus 37 on 3 contracts. So it's probably just commissions. Hey, I think I only saw $37. Yes, I only saw $37 shorting a huge update. I'm telling you, you guys can do it too. All right, I know I took up a lot of your time. I appreciate the questions. I really appreciate your interest. The next step here is just go on to nofttraders.com. Nofttraders. I'm spent, you guys. You can go to products, ultimate trading program, advanced trading group. Do your due diligence, you guys. There is a 2-week trial. There is a purchase outright opportunity, and there is a payment plan. All right. And again, you're not just most importantly, you're not just buying an indicator. As I'm telling you, there are indicators out there, great indicators out there. You got to have someone who's going to teach you how to use it. And then if you learn how to use it, well, why shouldn't I give you money? Right? All right. Hey, have a happy Thanksgiving. Thanks so much for the questions. I really appreciate it. Yes, we're all done. You have any last questions? Go ahead. Oh, crude. Okay. Look at that. Oh my. This is where I shorted up here, you guys. And this is where I got out. It looks like I continue that thing. Oh, by the way, here is the homework page where these blue lines are identifying levels. So the long that I took, was based off of this information here, this homework level here, and this homework level here. And remember the target was this homework level here. And then now it became support, I shorted it back down to that level. All I'm doing is looking at information at this homework level to get long. And this is an inventory indicator. So this is telling me that as prices are going higher, the difference in the buys and the sales, if this continues above the previous, you want to stay long. You want to stay long. You want to stay long. Now it's starting to auction. Now it's, this and that.